Jerome Powell, what have you done to the cryptocurrency market? Last night, we had a bit of a sell-off that has lasted through to this morning. Don't worry, we're going to be filling you in with exactly what happened. And the short and sweet answer is, this is just the cryptocurrency market being the cryptocurrency market. You are dealing with the most volatile asset class that there is, period. And when there's any kind of uncertainty introduced to the market, which I wouldn't necessarily say Jerome Powell perhaps introduced, but he was certainly, I think, a little bit more hawkish and not as forthcoming with the possibility of rate cuts as people may have expected. Also today, you've got the Bank of England just literally decided to cut rates. We did do a video on why we're bullish on UK housing, and we took a technical approach, i.e. we looked at multiple charts across multiple different sectors, all relating to the housing market, and they're all pointing in the same direction. It aligns with global liquidity. It's very fundamental in regards to, obviously, rates coming down. That makes money cheaper to borrow, so on and so forth. But that video's out there. You can go and watch that. We're not going to spend too long speculating on it. We just brought up the Bank of England because it's significant. Because after yesterday, you've seen a bit of a kind of swagger be put back into the dollar, if you will. And we're certainly seeing it gain ground today in regards to the Great British Pound. As, of course, they've decided to lower rates. And I think what's happening right now more broadly, we're going to be getting into what Jerome Powell had to say. We'll be playing the main sort of takeaway in regards to monetary policy. When it was a 40-something minute press conference. We're going to be really just playing the first couple of minutes. We'll be speeding it up and sort of cutting out as much as we need to help you get the sort of bulk of really what was importantly said there. And then we'll be playing you one question that he was asked to in regards to September and the rate cuts that take place there. I don't think he was particularly hawkish, but he was probably a little bit more hawkish than what people expected. Despite this, the stock market did rather well. So, of course, we are going to be starting things off by talking about JP, what he had to say, dollar getting a bit of a kind of spring in its step, if you will. However, do go and watch yesterday's video. We did talk about the dollar and the direction we think it's broadly going to go in. You're going to have sort of counter to the trend that we're sort of setting out points. And I think with them not lowering interest rates and just sort of discussing the possibilities if they see data of a September one, certainly with the Bank of England lowering rates, we know the EU have, so on and so forth, they're all doing it. This is kind of, it's seeing the dollar sort of not roll over just yet, but it will. They are going to lower rates. We spoke about why them lowering rates is going to see the dollar roll and what that means for risk more broadly. We'll be talking about something that he mentions. It's going to be heavily focused on yesterday's FOMC, and then, of course, we'll be diving over to Bitcoin. This is just a normal day in the cryptocurrency market, ladies and gentlemen. Unfortunately, the altcoin market gets thrown around violently, but you've got to be in it to win it. Everyone wants those amazing returns. No one is willing, well, we are, and many of you that follow us are, willing to sort of sit through the volatility that's so inherent to this space. So, without further ado, let's dive into the first part, the important part, in my opinion, of Jerome Powell's speech.
Inflation has eased notably over the past 2 years, but remains somewhat above our longer-run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond.
So he's very much following the same script that he has been. We didn't play the first bit of the opening thing because it's literally just him reading what he's been reading now for months. It's all about inflation, which we think is a slain beast. We're watching oil very carefully as it's so linked to the Dixie. And we always get the comment, I just want to address this, right, that inflation hasn't been slain in terms of realistically the fact that you're now buying things. Certainly if you live in the EU. EU is a way worse situation. Speaking to someone from Malta this morning, the average wage there just does not match the cost of living. In the UK, it's a better situation. It's still not. So we know inflation is it's unacceptable generally, and their stats are exactly that. They're stats that they bend to their will. But when you look at it from an economic data point of view, we do think inflation is a slain beast. Whether that is real term and really what's going on is another story. But from an economic data point of view, which was the data that they use to drive the monetary policy, we think inflation is a slain beast. And we think they see that too. We don't see a 1970s style resurgence. We've been against the ding-dongs that have been saying that because it's not the 1970s, quite frankly. So we think inflation is slain, and we think actually there is cause for concern in the unemployment market. You are going to have... and let's just pull this up. Let's go over to the trusted Forex Factory. We'll get into Bitcoin in just a second. So Bank of England, by the way, have cut rates. This has put a little bit of a pep in the Dixie's step. So you can see that. Dollar kind of firming up a little bit, most notably against the Great British Pound. You can see this kind of supporting. This is not yet a broader uptrend. You need to run this first. I don't think you are going to, in my opinion. But the dollar kind of firming up on the back end of this, and of course Bank of England lowering rates. Really importantly, given what he said, you've got inflationary data, which we'll come on to in just a second, but you've got non-farm on Friday. So tomorrow, with the unemployment changes, which is important to watch. Because we don't want this to go up. We're in the bull camp. We don't want to see unemployment rise, and we want to see inflation continue to not be a problem. This soft landing scenario, which we've been saying we think we're going to get, or a kind of no landing scenario, take place. What I want to do now is play you a second clip of a question he was asked in regards to September's meeting. I think broadly what this has done is sort of people get, they go all in. Rate cuts are coming. Okay, it's going to be spectacular, and basically Jerome Powell's kind of gone, yeah, they're going to come. It's very likely they're going to come, but at our pace, we're not going to zealously rush to do them. We will if there's any kind of a reason to, but as it sits right now, we're quite happy. And I think the markets go, oh, okay, well that wasn't the best scenario, but it's somewhere in the kind of middle, and maybe we need to chill a little bit. And certainly crypto bearing the brunt of that, I think. Let's dive into clip number 2.
Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
So I think that was the kicker right there. The fact that they basically said we've not committed to a September rate hike. It's kind of likely, but they're still looking at data points. And again, the real data points are obviously non-farm on Friday, and of course probably most likely the sort of CPI. So it's all to watch. Do go and watch yesterday's video. We spoke about the ramifications of the Dixie, getting that trade right, and ultimately what that means for risk. We think the Dixie's coming down, the dollar's coming down. We think this is fundamentally plausible with them cutting rates. They're kind of, like I say, letting other central banks go first, so that when they do it, it's not going to be as dramatic, if that makes sense, as what it would be if they were kind of the one to lead, or if they were to do it even at the same time. They're kind of letting things digest. Coming on to Bitcoin and crypto, this is still very much a pullback in what is a broader uptrend, guys. And this is very pullback-esque nature. This is not topping structure, in my opinion. It's not really ascending. It's a descending structure in what is a broader uptrend. And it's what we want to see, when you look at kind of basic market structure, and that's what we really champion, and then we look for technical patterns. So once we've understood how markets work, from a technical point of view, what they look like, we then add technical patterns in to help us improve our probabilities of being right. But if you look at a kind of, to use sort of Elliott wave, just very quickly as a kind of basic metric for an uptrend, you want descending structure in a kind of broadening channel. You will pop to the upside of this. I think crypto just being crypto, to be honest with you guys. I know people are peed off because they've had to wait. It's annoying for us because we've got so many things right, including a lot of the Forex market, the stock market. We've had so many targets hit. And if you look at when we got back into the crypto space, it looks great if we use total market cap of the crypto space. We got in here, and this is our accumulation period. When we were out in 2022, we will eventually be very right on a lot of the altcoins that we hold. I know they're a bumpy, volatile ride, but that's the nature of the beast. We haven't even seen anything of an alt season yet, and everything that we're looking at really concretes and cements that. It is also a great time, ladies and gentlemen, to join the Patreon, as it is the start of the month. Join it for a month. If you don't like it, you can always cancel your membership. We did launch a weekly Wednesday meeting yesterday. Really interesting information there. It should really sort of reignite the flame that may have been dimmed within you when it comes to the cryptocurrency space because of the chop that you're now enduring. Brighter days are on the horizon, guys, and what we spoke about today has a lot to do with it. Crypto is going to be the best sort of performing asset class in what is a generally good time for risk, in our opinion and assessment. That's it from me, ladies and gentlemen. I hope you enjoyed this content as much as I enjoyed presenting it. And on that note, I am going to love and leave you. Let me know your comments in the comment section, and I'll see you all in the next one. Thanks for watching, guys. See you in the next.